Welcome to another Velocity Juice podcast. I'm Flavia.
And I'm Delilah. Okay, so it'd be really good if you guys could tell us a bit more about your background and what you're currently doing at Velocity Capital.
Sure. So my background is from Deloitte in finance. I then moved to London and went into M&A, working on a range of transactions, but I really focused on the smaller or tended towards the smaller companies where you could really get stuck in and help those businesses. And that's when I knew I wanted to move more into the venture capital space. So I joined a family office and VC fund where we would acquire businesses, sometimes out of administration, merge it with another, rebrand, relaunch a product and sell the company on. And then the VC arm, it was an EIS fund investing in consumer tech businesses. And with that sort of background, I then moved on to Velocity, knowing that I loved consumer space. I love to direct to consumer, and I like really early stage businesses.
Yeah. And how long have you been at Velocity now?
For a year and a half.
Okay.
Oh my, congratulations.
Obviously you know that.
Yeah. Time flies.
Yeah.
Hugo?
And my background's originally as an entrepreneur. I had two different companies, sold one of them, and then moved across to a venture capital fund, which I loved, investing in consumer brands, and then moved from there to a private equity fund, again investing in consumer businesses. And then I spent about 3 years working with a range of mid-market private equity funds, looking at investing in tech companies and consumer, before I joined the Velocity Capital team earlier this year.
It's amazing. Yeah. Such a wealthy experience. Guys, I know that many of our listeners are going to be very excited in understanding how we make investment decisions and what is the sort of thesis for Velocity, the equity funds. So I think it would be really great to just discuss a little bit about when we say consumer, what do we mean and what kind of companies we search for in the marketplace.
Yeah, I can take this one if you like.
Yeah.
So it's probably worth explaining a little bit about the background of the fund. So it was set up by the ex-marketing director of Red Bull, who realised that about 40% of VC funding is going towards online marketing, and in particular Meta and Google. So there's a huge focus and cash being spent on that. So he set up Velocity with the idea to focus on that bit. So if you look at our portfolio companies, the common thread between all of them is that they acquire their customer online and have a significant spend on online marketing spend. It's usually about 40 to 50% of working capital. So that they're the kind of businesses that we look for, the kind of businesses that can be transformed with online marketing spend, which obviously fits very well with yourselves at Velocity Juice, to provide credit in order to supercharge that growth.
Yeah.
Yeah.
But in terms of, types of consumer brands, obviously one of the things that I experience, and I know you experience every day, is founders coming to us. So do we have specific verticals that we're more inclined than others?
Yeah, like what types of sectors?
Yeah.
So I'd say broadly it is consumer and tech-enabled businesses. But more than that, once you've met a founder, I think the strength of the founders, especially for an early stage business, is what can make or break it.
Yeah.
So having really strong founders, preferably if people have some sort of entrepreneurial background, if they've maybe started something before, even if it's failed, that's perfectly okay. At least you can see that they've got that tenacity and a sort of entrepreneurial spirit. And I'd say that's probably a big criteria that we look for.
Yeah.
Someone who's got an innovative defensibility to their product.
How important is the experience of the founder? I know that this is a tricky one. So obviously when we're thinking about commercial acumen, what do you guys look for in a founding team?
Yeah, I would say, so obviously the entrepreneurial spirit, sometimes someone could have come just out of university, but at university they founded something cool just with someone in their dorm. Yeah. You see they had that, or when they were 16, they say that they started some quirky little business on the side. So age, I don't think matters, but you do need to see that they were doing that kind of stuff in the past.
Yes.
So someone who is smart also knows their product and industry inside out. And when you speak to people, it's actually quite easy to tell who really knows what they're talking about and who doesn't. So I'd say that's really crucial. And probably resilience. you can see obviously that journey. There are loads of ups and downs, and someone who's resilient.
I'm absolutely convinced that viewers will pay money to understand what resilience is in the context of a venture capital investment.
Well, sometimes you can see they had a downturn, and then they had to completely bootstrap. They had to let go of some staff, and they stuck it, and they didn't just throw in the towel and say, "Cool, I'm going to move on to the next venture." And a lot of founders have that kind of story where they said it was a really tough time. Literally had to let go of everyone, had to rebrand, had to rethink our strategy, had to pivot, and we're still trying to do it. And I think that's a great sign.
In regards to specifics then, like how much do you tend to invest in businesses, D2C businesses, and the other support as well that you provide those businesses?
Yeah, so we have an SEIS fund, which at the moment can invest up to 150k, although that's potentially going up to 250k next year. And then we have our EIS fund, where we can deploy up to about 6 million in a company in a first check. So it's quite a broad range.
Added to which, of course, you've got a credit piece as well.
Yes.
Yeah.
Yes. So what kind of brands have we really, you guys backed, and what makes you very excited about the market in which we find ourselves?
It's a real mix of companies. So as you can imagine, with that focus of businesses that acquire their customers online, a lot of that's B2C type businesses. We're also seeing a lot of B to SME companies that are advertising in a very similar way. And some of those I think are really exciting, but our bread and butter is definitely D2C companies. And the kind of businesses I personally really like are the ones that are doing something different to Amazon. Because when you think of online retail, Amazon is such a huge company. So like we're looking at, one that's specialising in a category that Amazon just can't play in. It doesn't fit their logistics network at all and their business model. So it's those kind of ones that are doing something different and have a really differentiated proposition that can still market share from the incumbents at a kind of businesses I personally get very excited about.
And given some of the companies you've invested in, so what have been the results of that?
Yeah, so as you can imagine, with being at a VC fund, you have your sort of portfolio strategy, and it usually plays out that you have 10% of it that has your
your superstars,
Then you've got 30% that sort of do okay, give you sort of 3 to 5x returns, and then quite a few write-offs, and that's the nature of the market we work in with startups. Obviously we want as many of them to be successful as possible. So yeah, it's starting to pan out, certainly since Velocity Capital's now been around since 2016 I think was the first investment. So we're starting to see those superstars break out.
Oh yeah.
So like I'm working with one of our portfolio businesses at the moment, which is just ridiculous in terms of how they've been growing.
I know.
And they're doing a fundraise at the moment. And sort of despite what we're hearing through the jungle drums of valuations going down for early stage businesses and the rest of it, they're in a good place, put it that way.
Yeah.
Amazing. I guess what would be really interesting, many of the founders that I think all of us meet every single day are kind of puzzled by the sort of macro elements, inflation, cost of living crisis. How do you think this is going to affect our portfolio companies, which we at this particular episode we're all sharing and servicing to some extent? So what do you think are the key trends, and how are the best companies going to cope with this?
Yeah, I think we've certainly noticed, and speaking to other VCs in the space, that valuations were very, very high between 2019 and 2021. And so we are going to see them all come down now across the board, not just tech companies. And specifically seed rounds were very overvalued, and that's obviously where we sort of sit. So I do think that for our portfolio companies, some of them are going to have to consider perhaps doing down rounds if they're looking to fundraise now. But with that said, I think there's lots of opportunity. There's still loads of capital that people want to deploy, and they want to deploy it in the right companies at sensible valuations. So I do think there's a lot of positive to take out of it. And also so many unicorns there's a stat that I probably would know, should know, but of how many unicorns were actually born out of times.
Probably most of them.
Yeah,
Most of them.
of economic downturn. It's probably, I think it's over 90% of them or something that were founded in economic downturn times. So I think from a founder's perspective, they need to keep that in mind, that it's not doom and gloom. They can rise above it, and there is capital to be deployed. But I would also say that they should look to get a bit more runway if they were going to only raise for 6 months, rather take that hit on a bit of dilution and take a bit more capital if you can do so now.
I remember when I was on the investment side, when we had the referendum in 2016, I think there was a similar period where pretty much all the investors were telling their companies raise for 12, 18, 24 months. Is that something that you think is actually doable with lower valuations?
Well, exactly. We've been through this before, and this is a cycle, and it's a valuation cycle. And, who knows if we're at the bottom now or whether it's going to continue. But it is, as an investor, I'm kind of excited about these periods where we've got a period of lower valuations. And I'm less concerned, I'm slightly glass half full on this one, but less concerned about the macro environment, because there's a lot of stuff going on, and ultimately consumer discretionary spend is going to be squeezed, which has an impact on certainly our B2C businesses. Yes. But ultimately we're backing very early stage businesses that often have less than a 1% market share, and we're looking for businesses that are going to take market share from the incumbents. So just even if the overall market does go down, we, as long as they're able to continue taking market share and grow that, they're not immune from the macro trends, but less so than if you were a Coca-Cola and you were reliant on that market growing, because you're such a dominant player.
So you think that for all the emerging brands that are and founders that are listening to our podcast, the takeaway is to continue to execute and continue to keep that efficiency blended with a very good runway. Is that the key takeaway?
Yeah, and blended with having something that really differentiates you and makes, if you're B2C, or in fact, if you're B2 SME as well, so to make sure there's something where your customer would go to you rather than a competitor because of something different you're doing. And, to Kirsten's point around a lot of the unicorns being founded during periods like what we're going into at the moment, I think completely makes sense. It forces founders to, focus on unit economics and go back to sort of business fundamentals and grow it that way. And
focus also on building a really compelling consumer proposition, because I think so many consumers nowadays, they demand more than just a good price or a product that they like, that they need to actually buy into the entire business, the ethos, what they're doing, the whole story behind it. So I'd say founders that can build that will get brand loyalty, and consumers will stick with them for a lot longer. Otherwise, consumers will be a bit fickle with just choosing the first thing they see. But if you're able to connect with consumers on that deeper level, I think those are especially the consumer businesses, obviously, that will thrive, I think.
That's amazing.
Yeah.
Well, thank you guys for
coming in.
For joining us on this episode. And I'm sure that there is another session in the making to discuss of new business models and how consumer brands can increase lifetime value. I can already see it coming. But, it's been a pleasure. And I'm sure that the viewers and listeners will absolutely love to learn more. So we'll share your details and how they can apply to get funding from us.
Great, thank you.
Thank you.